Dan Cunningham, welcome from One Day in July. This is a firm that you started in 2017, 2016?
2016.
2016,
Yep.
yeah. Tell us a little bit about what is One Day in July?
One Day in July is a financial advisory firm, and we help individuals in Vermont and around the nation, but it's primarily in Vermont. And we help people manage their investments, do some financial planning, and then fundamentally try to understand what's happening in the financial world and how to use index funds, low-cost index funds, so that they capture the returns of the markets.
Tell us a little, what is an index fund?
An index fund buys the whole market at once. It doesn't have highly paid people behind the scenes trying to guess what stock positions, what's going to go up or what's going to go down. It basically says, you know what, in this asset class, like say it's large US companies, we're just going to buy them all and hold them all. And what's been shown over 50 years now in academic work is it's almost impossible to beat that. It's almost impossible. Your chances are way below 1% over time.
Yeah.
And so the idea is, well, why do we have this big financial industry making giant profits, taking fees out of people's accounts everywhere? Why do we have this if people can't beat the index anyway? It doesn't make any sense.
Yeah.
And the firm is founded on that premise.
Is that sort of are you sort of going against the kind of gambling idea around financial investment?
Yeah, without question. And the gambling is now grown with sports gambling and all these apps.
Yeah.
You know, you have these stock trading apps, which are basically just gambling apps.
Yeah.
That's really, really bad for people.
Yeah, let's talk about that a little bit. So your motto is simplicity leads to discipline, discipline leads to results. What is simplicity in financial investing? I mean, I think you've talked about it a little bit, but.
Yeah, I think if you index your investments, you don't have hundreds of positions. You know, we generally will have 10 to 15 positions, and we really understand how that position is going to work in different types of markets. So for example, one of the big mistakes is that you can't predict what's going to happen in investing, but a lot of people think they can.
Yeah.
It's just not possible. And so if you create a really simple program that you understand, when things go badly, which they will in investing, and they go badly, you know, in the news and nationally, there's problems all the time, then you have much more confidence in your plan and you stay with it.
Let's talk about that a little bit. That, you know, we can't predict. And then there's some controversy coming out of the White House right now where people are using their sort of inside information on these prediction markets.
Oh, without question, that's going on.
Yeah.
People, I mean, you can see it in the markets.
Yeah. And so that talk a little bit about that, prediction markets, and then how is corruption influencing those prediction markets, and how does it affect all of us?
Yeah, well, that's very bad development, and partly because as it grows, psychologically, people start to assume that's okay, and it spreads. And historically, the United States has, with insider information trading, it's been pretty firm on that. There's been a lot of prosecution over the years.
Yeah. If
that slides back and people start to think, well, you know, I might be all right. We're going to go back. You know, we're going to go back to the Carnegie, you know, J.P. Morgan.
We're not there yet?
Era. We might already be on the way. Yeah. But a lot of that wealth was just created through insider trading.
Yeah. Well, how does that affect those of us?
Well, you pay. I mean, you don't have the information, so someone else is getting the gain at your expense.
Yeah. Yeah.
It's just all happening within the market.
How did you come to do this? What's your background, and what drew you to doing this particular kind of work and building this firm?
Yeah, I have a software engineering and a consumer brands background before this. I'd worked in those fields. But since college, when I was introduced to this idea by professors, I had always been very fascinated about this, almost from an engineering level. Like, why does it possibly make sense that this industry exists and is as profitable as it is when it's not adding value for the most part? Like most other people, almost all other people in the economy have to do productive things to get paid. In finance, and this isn't just Wall Street. This is all over Vermont too.
Okay.
And they are underperforming the indexes almost always over time, and they're being paid a lot of money in different ways behind the scenes to underperform.
Okay.
Like what kind of deal is that? Who would take that bargain if they knew it?
Peel
that was
back the
happening?
curtain for me a little bit. As somebody who's,
So,
just peel
like how
back,
does it really work?
Yeah.
So what if the public really understood how much people in this industry are being paid? They'd be horrified, and that includes like financial people in Vermont.
Yeah.
And so what you do is you create a relationship that's close to the client. This is what they do, and they're a nice guy. You always hear that. Oh, he's a nice guy.
Yeah.
Well, the nice guy behind the scenes is actually working generally for like a New York company or some type of firm that needs to create a very large profit stream. And there's many, many ways to do that are very hard to see if you're not in the financial industry. And one of them is like if you put products into a client's account, you can be paid through the back door by those firms. And you can be paid a lot of money. They'll buy you all kinds of fancy trips.
Yeah.
Almost 90% of the industry is doing that. We're in the 10% of the industry, what are called fiduciaries, where we're committed to the client. No one else is paying one day in July. There are about 10% of the firms in the industry that are not being paid through the back door.
Yeah. How does somebody see that if they're working with a financial advisor or they're working? How do they begin to see those?
They're very hard to see. They're
Yeah.
embedded in the funds. I mean, you could find it in the small print.
In the prospectus, or
In the prospectus,
Yeah.
yeah, you could find it, but it's hard to do. And what will happen if you ask a broker or an advisor at a lot of firms if they're a fiduciary, they'll say yes, because they are maybe on one of the accounts.
Yep.
This is how they kind of get around
got it?
the fact that the public is starting to learn the term fiduciary.
Yep. Which you need to define for us here.
Yeah, so a fiduciary only acts in the interests of the client. But a lot of firms will have other accounts where they're not a fiduciary.
Yeah.
Or what's happening too is the public is starting to ask, well, am I invested in index funds? Because the public is starting to learn what this is. And so the advisor or the broker will put one or two positions in an index so they can say yes.
Yep.
And the rest of it goes back to active management or annuities or
Yep.
whole life insurance. That's where the big profit pools are. Like you want to stay away from that stuff as an investor. Annuities, whole life. You do not want exposure to that.
Yeah. So there's I had a question here about fixed annuities, which is something that comes up a lot if you go to, you get that. We'll give you a free steak dinner if you come.
Yeah, I was going to go to one of those to see. I've had annuity people at the office
gone.
to pitch.
I've gone
It's
to
a pretty
them.
compelling pitch in some ways.
Oh yeah, it's fascinating, and that was what came up. It was this fixed annuity, and I was like, this seems like a strange deal.
Yeah.
Talk about that a little bit.
Yeah, so if you sell an annuity, you get a very high percentage up front. It's very, very profitable, which is why they're paying for the steak dinners.
And you're basically investing your money in this,
in a very complex contract that an insurance company owns.
and that you'll only get a certain percentage
And
out
you'll
of
get-
until your life ends.
Yep. And you have to annuitize the product, which a lot of people don't do or don't know. But the insurer then has the cash. They will invest it in ways that make, generally a lot more than what they're promising. And the pitch is safety. So they sell very well when times are bad because it's a safety pitch. But the reality is there are much better ways to protect yourself than buying annuities. And frankly, in 2008, in the global financial crisis, many of those annuity companies would have failed if the United States Treasury hadn't come in and backed them up. So they weren't as safe as they were promising anyway. But that's how it works. And then it's very expensive because what you're giving up over time is the insurance company is haircutting the product. So they're taking a big gap between the markets and the investments and the promise.
Yeah. So, I mean, you started in a little bit about your background and what inspired you to create One Day in July. I think we're hearing a little of that, but tell us a little bit about the story of, why is it called One Day in July?
Yeah, there were really two things that July that happened. One is I read a big longitudinal study that the average American only gets one of every $8 in market return. About half of that is due to the financial industry, half of that is due to their own behavior. But that means most of the money.
Can you repeat that again?
One in eight of the market's return, $1 in $8 goes to the investor that takes all the risk in America. So that you look at that a whole lifetime of work and you end up with a tiny fraction of it.
Yeah.
That was like, wow, how is that happening? Like that is really, really terrible. And then the same month, actually, my son had gotten out of kindergarten in Burlington, and that year, the top 8 hedge fund managers in the nation made more than all 86,000 kindergarten teachers, and they did it a lot with teacher pension money. And that includes Vermont, and it includes Vermont right up till today. Vermont is still doing it. They hand over all this capital from the government employees and the teachers, and they give it to highly paid fund managers. And generally, those managers underperform for the teachers and the government employees. And that was actually
your proposition would be
they should just index the whole
we
thing.
should just index it and be done with it, and there'll be enough of a return to pay the pensions.
Oh, the gap, and I've communicated this to different people in the government for years. The gap would be billions and billions of dollars.
What's the resistance? Why are people resisting this?
Inertia. I mean, there are certain places. Nevada, there's a state treasurer in Nevada who's really, really sharp and is on this. I think Pennsylvania does it.
Okay.
But even the top 25 university endowments, virtually all of them have underperformed the indexes. They're not even close. And if they each spend about $200 to $250 million a year on investment advice, each.
Yeah.
And they can't come close to the indexes. There's no way states like Vermont and their managers are going to beat this over time. It's just not going to happen. And so what's happening is because the general public, like you and me, we have to shovel all this money over to support these pensions. It's an enormous tax on everybody in Vermont.
Yeah. One thing I was curious about, I generally bank at credit unions, have done that work. And I'm always kind of scratching my head, like when I was younger, you could put money in the bank and it would have a decent, interest return.
Yeah.
You can't do that. You actually,
a little better than it was.
There's no incentive to actually put any money in the bank, right? And I downloaded the Acorns app.
Yeah.
Because it was being sold to sort of help you put money aside.
Yeah.
What can banks and sort of everyday financial institutions do to help people realize something like you're talking about? Be able to save money, have it grow enough so that when they need to go to school or buy a house or put in a down payment or take a trip, they have resources.
That's a good question. I mean, I think that one of the things that really does work is the financial planning concept called pay yourself first. And you don't have to use a retirement account. You can just use a brokerage account and every month automatically sweep a certain amount into the account. And the reason that works, and that we've seen this with our client base, we have about 2,000 clients. The reason that works is that it takes the money out of the account before you figure out the rest of your spending. And psychologically, it's just, they call it pay yourself first because it's gone and then it's invested.
Yeah.
I don't think, you have to have money in banks to pay bills and things, but leaving lots of money in bank accounts is very, very good for the bank.
Because they're investing it.
They're investing it.
Yeah.
You want to have that money deployed into investments that are going to have higher long-term returns than a bank account.
There are now banks offering things like sweep accounts where they'll put your money into an investment and then move it back to make it more liquid. But I mean, that sort of brings me to, like, is there different basic financial advice you'd give to people at different stages of life? Their 20s, 40s,
Definitely.
60s, 80s?
Without question.
Yeah, talk about that a little bit.
Well, I mean, one of the things that is, that we really try to do at One Day in July is you have to realize that index funds are exceedingly democratic instruments. Like, this is not, you have to be a high net worth investor to make money. Like, if you buy an index today, you're going to roughly match Warren Buffett's returns over the past 20 years. He effectively matched the index. I was actually at the Berkshire meeting, I think in 2001, and he said, I'm almost certainly just going to match the index from here. Like, I probably won't beat it.
Yeah.
So you have the ability very easily.
That's him doing individual, like he's trying to predict and make investments.
Yeah, but he was
smart
sort of
way,
saying, I'm not going to be able to beat the index now. So as an investor.
And is that over the long term? Is that the like?
Yeah, that's over a long period of time. But that's a really, really positive thing because you can get started and you can have returns that are going to beat, it can't be guaranteed, but the chances are very high you're going to beat the top 25 university endowments. Chances are very high you're going to beat Berkshire Hathaway. You're going to beat the state of Vermont probably by a long shot. Like, these are things that are really positive, and you don't have to be high net worth to get started down that path.
Yeah.
The same index that a very, very wealthy person can buy is the same thing that somebody who's just starting out can buy. And where this industry is funny is normally very wealthy people think, oh, I can buy a better boat or a plane or a mansion or whatever, like that money's going to buy me more.
Yeah.
Money can't buy you more performance anymore in the investment industry. You can't go to a bank, a fancy New York bank, and say, I want higher returns, I have a lot of money. It just won't work. The index is the index.
Yeah.
So that's a really positive thing for people.
I have this, what's the worst financial advice you've ever heard doled out? What's
That's interesting. I haven't gotten that question. I have to think about that for a second.
you can come back to it and maybe circle back because I'm going to ask you about sort of two hot button issues, which has to do with real push to invest in cryptocurrency.
Yeah, well, I was going to say that's probably the worst. Like, crypto is probably the worst financial idea I've ever seen.
And yet originally designed by sort of this anarchic impulse to spread wealth and to democratize our ability to be part of the financial world. So why? What's going on there?
Yeah, I mean, it's a very complex series of algorithms under the hood. I mean, a lot of money is lost in crypto wallets. A lot of coins are lost. So you have that risk right up front.
Yeah.
I mean, who knows what's actually happening from a securities perspective. It's effectively unregulated. I mean, you need to have police in the financial industry. You need to have regulators on these markets.
Yeah.
Financial actors tend to do pretty corrupt things pretty quickly. And you're in the Wild West in crypto. And that's a scary place to be. You do not want your assets exposed to those types of risks because it's not even clear what all of the risks are.
And it's not insured.
It's not insured. And then what happens if, basically, you're buying something that is just an algorithm. I mean, you're effectively saying, if you buy a business, it's producing something and doing something productive for the world. In crypto, you're buying this digital token, basically, that you're just hoping somebody else pays you more for. It doesn't actually do anything. The only real purpose is illicit transactions, which isn't exactly good for the world either. Mm-hmm. But it's not a productive asset. It doesn't create cash. It doesn't
Even
sell.
now that more of those businesses are also using cryptocurrency, is that sort of the idea that people want to replace cash with cryptocurrency?
I mean, that's an idea. Yeah, it doesn't. I mean, that's a pretty marginal. 15 years into this, it's a pretty marginal use case.
Yeah.
maybe there are some use cases on blockchains that are actually productive use cases. But the idea that you would take all of those risks to bet on something, hoping someone else is going to take it off your hands at a higher price,
Yeah.
that's a really, really bad financial move.
Yeah. So there's sort of the opposite of that, and maybe it's not the opposite of that, is this idea that gold is the investment that one would make now because it's real.
Yeah.
It's
a little bit better idea than
consistent,
crypto.
It's gone up,
It's very popular right now because it's had a
Yeah.
big run. I worked for a gold mining company in college, actually in the deserts of New Mexico one summer.
Wow, what was that like?
It was.
What did you do?
I lifted gear for geologists up mountains. I mean, I was like.
Did you actually get to pull some, extract some gold?
We found gold, but not enough to be economical.
You were cracking rock for gold, or
We were soil sampling,
cool.
and and so one of the things that people forget about the gold market, again, gold is an asset that actually doesn't produce any value, doesn't produce anything. There's no
Yep.
cash flow.
Yeah.
There are some uses, primarily at this point, in jewelry, primarily in India, but it is an industry where gold miners know where there's a lot more gold in the ground, and if the price comes up, they are going to go to work getting that gold up out of the ground, and so people kind of forget that if the supply comes up in a year, the price is going to come down. Mm-hmm. And there are a lot of known gold reserves. The price just wasn't at the right point to get to it.
Yeah, it seems like there would be other precious metals that you would also want to invest in if you're going to go that route.
Yeah, there's others. To give you, it's not very good in terms of being a hedge, though. Like in March, when there was a crisis in the world and you wanted a hedge, gold actually went down about 10% in March. In the global financial crisis, when you really needed a hedge, it went down significantly. So gold does not offset the stock or the equity market very well. And over long periods of time, of the major asset classes in America, it's been the worst performer by a long shot when you consider dividends and interest payments from investments.
So if somebody's faced with, an inheritance or a larger set of, a larger chunk of money, what about real estate investments?
That's a good question. Real estate acts almost as a half bond, half stock, as kind of characteristics of both. It tends to be fairly illiquid, like it's hard to get in and out of real estate transactions. And right now, people should talk to us because there are a lot of very bad products that are being introduced by Wall Street in real estate. They're very illiquid, and you can get into them and you can't get out of them.
And so it sounds like you're talking about, like, there are markets, real estate markets you can buy into if you have money, and then there's also the idea of, like, I'm just going to buy a piece of property in Williston.
Yeah.
I have some cash, and I'm going to hold on to that and let it grow.
I think your chances of outperforming the stock market doing that is very, very small.
Interesting.
I think people, if you like doing it and taking care of houses, I would do it for that.
Yeah.
But a lot of people made money in real estate, not really from their real estate choices in the past 20 years, but because interest rates came down. And they had bought the property here, they had a mortgage here, and then the interest rates came way down, and then suddenly their cash flows, they refinanced and their cash flows went up.
Yeah.
So that's not really a real estate trade in a sense. That was an interest rate trade that they made the money on.
Yeah.
And one thing to keep in mind is if you really wanted to do that, you could borrow money and buy the equity market. People do. It has risk in it. But it was the borrowing of money and the leverage that made the returns more than the real estate market per se.
One of the, we talked a little bit about, you have 2,000 clients, is that right, across the state of Vermont? You're just in Vermont?
Well, no, they're in 30 states.
30 states, okay.
But most of them are in Vermont.
And financial advising and the conversations that you have with your clients are really about their lives and about what they value and how they view their community. Talk a little bit about that. How does
that's
this
the fun
give
part
you?
Of the job.
Yeah, how does this give you a connection to the community that we're in and the people that you serve? And
Well, I mean, people, and we obviously keep things really private,
yeah,
but people are willing to tell you a lot of things as they get to know you.
yeah,
And there's an element to the job. It's helpful for us to know who the clients are. But then in Vermont, I always say Vermont's like, I grew up in southern Vermont in Bennington. It's like a big town.
yeah, yeah,
But you hear all of these different opinions and things from different parts of the state. Because we have 7 offices in Vermont.
yeah,
And that's just a really interesting part of what we do.
yeah. And how does that affect you personally in terms of your involvement in the community and your attention to what's going on, say, in the legislature?
Yeah, I think it can. I think talking to people makes issues much more real than just always seeing it in the news.
Yeah,
When someone's really struggling with a problem, and it's the problem that you saw in the news, but they're really struggling with it, there's an empathy that comes out of that reading a news piece doesn't always deliver.
yeah. Let's talk about the news really quickly before we have to close. We have these escalating oil prices. We have conflict. We have who knows what's going to happen to democracy.
Yep.
We have a lot of fear and a lot of the market going
The market's
up
gyrating.
and down
it's-
like crazy.
right.
What do people do?
I know.
How do you give us your therapeutic financial
Yeah,
advice?
I mean, for one, you want to. That is a reason why you want to index, because within the index, it's incorporating everything. But the really critical thing is to separate, on a financial level, to separate the news from any investing decisions. They have to be separate from each other. And the investment decisions need to be made on academic research. And then the news is the news. But if you say that I saw bad news, I want to sell these investments, the market knew that a long time ago. I mean, the market is way ahead of the news cycle in figuring out information. And so if you're reacting to the news, you're significantly behind the trade. And so you really just want to try to decouple the two things completely, which is hard to, I mean, it's easy to say that, but it's hard to do it.
Is there a source? Is there a news source that you feel is closer to the beginning point? Is there something that you're looking at or reading?
The financial industry will tend to use 2 big ones. They use Wall Street Journal and they use Bloomberg.
Yeah.
And what's interesting is actually Bloomberg's kind of, I don't think people in the financial industry are like overly reading the opinion pages, but one's a left-leaning operation, one's kind of a right-leaning operation, but those are the 2 big sources of information for what's actually happening in the financial world.
We talked a little bit about apps that are out there. It sounds like your advice is if you got money, put it in index funds.
Yep.
You all do financial advising. Do you recommend that folks find a financial advisor to work with?
Yeah, I think it's really helpful in the sense that there are a lot of issues, sort of technical issues of how to construct a portfolio, things you want to be aware of. And then there are many, many behavioral issues. And if you make a behavioral mistake, if you trade out of the market because you're worried about something, and you do that once in a decade, you can lose a very significant portion of your returns for the whole decade.
Yeah.
And so even internally at One Day in July, we've really thought about this a lot of how do you structure a firm to offset behavioral mistakes as well? Because the financial industry will make those mistakes because everybody's human.
Yeah.
And so even within firms, those mistakes are being made. So that can really help people to decouple from the news cycle and from worrying about their investments. Say, well, One Day I will worry about it for me.
Yeah.
And there is an element of truth to that.
Yeah.
It takes it off people's plates and then they start to feel better about it.
Yeah. And for sort of the younger generation of folks who do want to use those apps, are there ones that you recommend or ones that you say stay away from?
I wouldn't use anything I would definitely stay away from Robinhood. That's just pushing all kinds of trading that we would not recommend. you know, if you use it, you can use an app, but just buy an index
Yeah.
inside the app,
Yeah.
and then don't do anything
Yeah.
beyond that, or several indexes. It's good actually for various reasons. Like we'll tend to own 10 to 15 indexes that line up with different asset classes.
Yeah.
But don't get into this world of trading every day or every other day. I don't think there's a chance you're going to win.
Yeah. Yeah. It is gambling.
It's gambling. That's
Yeah,
just
yeah.
outright gambling.
Yeah. Well, Dan Cunningham, thank you so much.
Thank you.
Thank you for coming in and sharing some words of wisdom with us. And one day in July, for those of you who want to, I think the website is there on the screen. Thank you for watching.